Welcome to today's review of the True Potential portfolios and financial markets. My name is Paul Durrans and I'm an investment analyst at True Potential, and I'm also delighted to be joined by our investment director, Barney Hawkins, who is the fund manager of the True Potential Growth Aligned Funds. We are both part of the team that manages the True Potential portfolios. So Barney, following a generally sustained period of positive market performance, markets have clearly been more challenging over the past couple of weeks. Equity markets across the board have fallen and bonds have offered little protection. I think the question everybody wants to know is what's been happening and what was the reason behind the recent pullback in markets.
There were a number of reasons behind the sell-off, but the trigger was an improvement in the US labour market conditions, where unemployment fell to 3.7%, which is the lowest level in nearly 50 years, and weekly wages rose at an annualized rate of 3.3%. So that was the catalyst for the sharp rise in bond yields. Markets reappraised their expectations for higher interest rates. The yield on the US long bond moved from 3% to 3.2%, and yields elsewhere pushed higher. Markets are now converging towards the Fed's own forecasts.
So with fewer people out of work, the demand for skilled workers increases, and they in turn are able to demand higher wages from their employers. Higher wages can then generate actual inflation as consumers have more disposable income to spend. If higher inflation comes through, higher interest rates are then needed to help contain it. Within the equity market, have there been any trends which you have observed?
We're beginning to see the first tentative signs of a rotation out of high-value growth stocks such as Facebook, Amazon, Apple, Netflix and Google, the FANGs, into lower-rated stocks with value characteristics. It's too early to say whether this trend will be sustained, but it is a reminder that for active managers, this volatility presents an opportunity.
Is this a bit of a rerun of what we saw in February, and have there been any signs of a bounce back?
It is similar to what happened in February this year, when we saw better jobs data and wage growth, which then led to interest rate expectations being revised, and the market briefly sold off then. We know that markets in March and April swiftly recovered. Whether we get the same result this time around, only time will tell, but there are some early signs of recovery from the equity markets.
Last week we spoke to all of our manager partners during the sell-off. What messages were they giving, and were they adjusting the funds in response to the recent events?
To some extent the downturn was expected, whereas Europe, the UK and emerging markets had been drifting back a little, the US had been powering ahead, so some correction in the US was arguably overdue. The sell-off was also exacerbated by ongoing political concerns, trade wars, Brexit, emerging markets, and what's happening in Italy. The speed of the decline is also a function of hedge funds and program trades. They have said that the fundamentals in general haven't really changed and still look broadly okay. It's been the sentiment rather than the fundamentals which have caused the market sell-off. In terms of repositioning, most of the managers were reviewing their stock and sector exposures, but not really making any major trades during this period.
This week we've had our rebalance meeting for the True Potential portfolios. Have you needed to reposition the portfolios at all?
We've not needed to do too much this month. We're happy with how the portfolios are positioned in terms of asset allocation and manager exposure. We've made small adjustments to the Cautious Plus portfolio by trimming the True Potential SEI Defensive Fund to reduce manager concentration, and we've added to the True Potential Defensive Fund. This reduces the exposure to both high yield and emerging market debt, both of which are likely to remain volatile as US interest rates go up. The switch also reduces the overall cost of the portfolio. and we've carried out the same manager switch in the Balanced Plus portfolio for the same reasons.
So to sum up, we still remain constructive on markets, positive on equities and underweight bonds. Monetary policy is still loose and not yet restrictive for economic growth. Valuations, earnings growth and economic data globally is still pretty good. Of course, diversification remains paramount at this stage of the economic cycle, and our managers continue to look for alternative sources of return.